Gold just hit $5,000 an ounce. Everyone has a theory why. Inflation, the dollar, fear. Here's the uncomfortable truth. The answer changed. For 50 years, gold followed two rules. Then, in 2022, something snapped, and most people still haven't noticed. Let's draw it. 1971. President Nixon cuts the dollar's tie to gold. The world's oldest financial marriage ends in divorce. Gold is free to float. From that day on, gold and the dollar became rivals on a seesaw. When one rises, the other usually falls. Rule number 1. Why? Gold is priced in dollars. When the dollar weakens, it takes more dollars to buy the same gold. Weak dollar, expensive gold. Simple. So is the dollar the driver? Partly. But there's a second rule, and it's the one professionals actually watch. Gold pays you nothing, no interest, no dividend. So when savings accounts pay well after inflation, real rates, gold loses the race. When real rates are high, gold sleeps. When real rates go negative, gold wakes up. Rule number 2. The quiet boss of gold. Check the history. 1980, inflation panic, gold spikes to $850. 2011, debt crisis, 1900. 2020, money printing, 2070. Every peak, same recipe, scared money plus punished savers. Inflation mattered, but only through the dollar and real rates. That was the old world. Then February 2022, Russia invades Ukraine, and $300 billion of Russia's reserves get frozen overnight, switched off. Every central bank on Earth watched and learned the same lesson. Dollars can be turned off. Gold in your own vault? Cannot. Enter the whale. Central banks started buying gold at roughly double their old pace, over 1,000 tons a year, 3 years running. And here's the key. They don't care about price. They buy at 4,000. They buy at 5.5. They're not trading. They're escaping. Surveys say 43% of central banks plan to buy more this year. 95% expect global gold reserves to keep growing. That's not a trend. That's a shift. A price-insensitive buyer removing supply every single month puts a rising floor under gold, a floor that didn't exist before 2022. That's why the impossible happened. Gold rallied while interest rates were high. The old rulebook said no. The whale said yes. Then 2026. Gold spikes past 5,400 in January and drops 16% by spring. What happened? An oil shock pushed inflation up, and gold went down. Read that again. Higher inflation, falling gold. The inflation hedge story just failed its test. Why? Hot inflation meant fewer rate cuts, meant higher real rates. Rule number 2 still works. It just shares the wheel now. So the real ranking today: 1. Central bank buying. 2. Real rates. 3. The dollar. 4. Fear. Inflation? Only through the others. Here's the reframe worth remembering. Gold isn't an inflation hedge. It's a distrust hedge. It rises when trust in the system falls. For the big picture, growth assets are your engine. Gold is an anchor some keep for storms, different jobs. Knowing the difference is the whole lesson. So what drives gold? Not one thing. A new world order of buyers. Now you know what to watch. Subscribe. The flywheel keeps turning.